When you're talking about your assets, like your funds to close, we talked about your down payment, but when the lender looks at your bank account, they're going to be looking at All right, so today we want to talk about FHA loans, or maybe call it FHA 101. If I was to think about the best first-time homebuyer loan, I would probably say it's an FHA loan, just because of all the flexibility that it has dealing with your income and your credit, even the source of your assets and the way they look at your debts. And so wanted to kind of discuss the framework of an FHA loan so you get a good idea of what's involved in it, and then we'll talk about some of the specifics around those different sections I just mentioned. FHA loans are great, and the reason why I say that is because they allow for you to buy, pretty much, over a $500,000 property for just 3.5% down. So when you're talking about what's your required down payment for an FHA loan, if your credit score is 580 or higher, you can put just 3.5% down as far as a down payment. And you can ask the seller to pay for pretty much all of your closing costs because it allows for the seller to contribute up to 6% of the sales price. That usually covers all of your closing costs. So you can literally acquire the property for just your down payment. Now, what do you say if your score is not a 580? Can you still use FHA? For sure, right? Now you're going to have to put 10% down, right? If your score is below 580. So if your score is between 500 and 579, you're still eligible for an FHA loan, but you're going to have a larger down payment. Well, maybe everybody doesn't have 10% down, or maybe they don't even have the 3.5% down. It does allow for down payment assistance within certain credit scores. Typically around 620 or higher is what you're going to need to be able to use DPA. You can get a gift for the down payment. It could come from a person who's a relative by blood or marriage. It can even be a friend, a longtime friend, somebody who has a personal investment in your financial future. It could be a fiance, right? So getting a gift is a great source of funds because somebody believes in you enough to help you achieve the goal of home ownership. So just because your credit score may be on the lower side or it's got some bumps or bruises definitely doesn't hold you back from being able to get qualified to get a home loan. So we know about credit, we know about the down payment requirements, but the income is really important. The way we calculate the income on FHA, it's more flexible than most loan programs because it's designed for first-time homebuyers. It's designed for people that may have had some turbulence or some job gaps or some instability within their work history. So we always look back at the last 2 years of work history to kind of determine what is going to be stable, predictable, and likely to continue income. So whether you get paid by the hour, you get paid a salary, some people are on a commission base, some people have retirement income. There's a lot of different calculations for it, but FHA has some really cool ways to make exceptions to certain rules. For instance, commission income or overtime income. Those are typically variable pays that fluctuate from check to check. Usually you have to be receiving that for a couple of years in order for a lender to say, yeah, I believe that this income is likely to continue. FHA will allow you to use just 12 months. So I've been employed, getting paid an overtime wage. I've been receiving overtime from my current job and maybe a previous job. As long as it's been more than 1 year and less than 2, and the lender has a good reason to make an exception, meaning you've been working in that line of work or you've got really consistent hours or the employer that you're working with comments that it's likely to continue. Most lenders aren't going to have an issue with using that overtime, even though you've only been receiving it for a little more than a year. That's a great benefit to an FHA loan. When you're talking about your assets, like your funds to close, we talked about your down payment, but when the lender looks at your bank account, they're going to be looking at your payroll deposits, any other kind of non-payroll deposits. Large deposits are basically considered anything more than 50% of your repayment income. So your qualified income, right? If it was $5,000 a month is what your qualified income is, any deposit less than $2,500 is not going to need to be sourced because it's not going to be considered to be a large deposit. So that's a really big benefit because sometimes people have deposits that come from side hustles or other, income sources that they don't necessarily have proof or need to disclose. As long as the deposits are not more than 50% of your repayment income, you don't need to go through sourcing it. So that's a really good benefit to a first-time home buyer. Then you look at your debts. How does FHA look at your monthly installments or your monthly revolving debt? Remember, as a lender, we're only going to be using debts that are financed, debts that are needing to be repaid every single month. So installment debts, student loans, credit cards, those are all finance debts. We're not going to be concerned with your self-reported utility or your self-reported rent. We're not focused on those. But we do look at derogatory debt, debts that are collections or debts that are behind. We have to evaluate those. And so for collections, If you have more than $2,000 in open collections on an FHA loan, the lender's gonna have to hold 5% of the balance against you in your debt to income ratio. Debt to income basically says, what are all my debts divided by my income? So sometimes people don't qualify for what they're looking for because they have too many derogatory debts, too many debts that had gone bad in the past, and now they're having to account for a financial obligation. FHA basically says, if you were to make these debts correct and make them whole again and repay them, what would be the likely amount that you would pay? And it's 5% of the total collections if all of them together equal more than $2,000. The other thing you need to watch out for FHA loans is disputed accounts. So on your credit report, if there are any trade lines that are derogatory, meaning they've been past due or late in the last 2 years, those derogatory accounts are going to require your loan to be manually downgraded. Manually downgraded is not a death sentence, but it definitely does mean that your loan's going to be scrutinized more. The ratio restrictions are tighter, the reserve requirements are more, and the acceptable credit history definition now comes into play. So there's two types of loan approval. One is electronically approved, meaning your income, your assets, your credit, and your debt have all been run through Total Scorecard, which is the electronic approval engine that FHA uses to underwrite all their files. If that file does not get a thumbs up, it's an accept, it's going to be referred, right? And now an underwriter for the lender has to manually underwrite that file, and there's a lot of steps that go along with the rules, but credit is a big part of it. In order to have acceptable credit, you can't have any lates on any installment debts in the most recent 12 months, and you can only have 2 lates on any installment dates between 12 months and 24. It's pretty significant considering people have student loans and other debts that may have had some late pays in the past. Revolving credit, a little bit more flexible, right? Doesn't matter how many 30-day lates you have in the last 12 months. They're only going to look back over the last 12 months. But if you have more than 3 60-day lates, you don't get an FHA loan. And if you have any 90-day credit card lates in the most recent 12 months, you don't get an FHA loan. So I see disputed accounts quite often on credit because people like to hire credit repair companies or they dispute things on their credit report, and not knowing that that disputed account now suppresses the data from the algorithm, meaning the credit bureaus have hidden that derogatory event from your score, which means your score is probably a little bit higher because that collection or that derogatory debt is not represented in your score. Those disputed accounts, they can require your lender to manually downgrade, and this is where deals die in underwriting. Make sure you're talking to the right lender that's reviewed your credit in its entirety and you're aware what's on your credit report. And so you know about disputed accounts and how collections are calculated, so you're not caught off guard thinking you're going to get the keys to a new house and then underwriting says, I'm sorry, you're not approved, and your loan gets denied. FHA is really a great loan product. I highly recommend people use it if they're a first-time home buyer. It's not the only loan program that's out there, but it is a very special program, and it helps a lot of people get the financing that they need to get the homes they want.